Kitco Mining special coverage of BMO's Global Metals, Mining and Critical Minerals is brought to you by First Majestic Silver.
Hello and welcome to Kitco Mining with me, Paul Harris, here at the 2025 BMO Global Metals and Mining and Critical Minerals Conference in Hollywood in Florida. Gold prices are up and the gold producers are starting to show much better performance. Joining me to discuss this today is Paul Rollinson, CEO of Kinross Gold. Paul, welcome back to Kitco.
Thank you for having me.
Now, Kinross Gold had a very good 2024, 2 million ounces of production, $1,100 per ounce, all-in sustaining cost margin, record free cash flow, a lot of debt repaid, and your share price is up 123% year on year. A lot to celebrate there, but what were the standout achievements for you last year, Paul?
Well, look, I think there's a sequence to how we get to that record free cash flow. Number one, I'm a big believer in corporate culture, and our culture is really around strong technical acumen. So when we set our guidance, it's a very robust process, a lot of interaction between tech services and our mine sites. And so when we put that guidance out, it's been well scrubbed. So the journey starts with meeting production guidance, and we did. After meeting production guidance, it's all about managing your cost profile. And I think one of the contributors to last year's success was, after meeting production guidance, holding the line on costs. And where you saw that manifest was our margin expansion through the year. So our margins expanded by 37%, while the gold price was only up 24%. So that's holding the line on costs in a rising gold price. You then take that cash flow and we did what we said we would. In our capital allocation strategy, we talk about the needs of the business, the needs of the balance sheet, and return of capital to shareholders. The journey we were on last year, we said we're prioritizing debt repayment. And to your point, last year and just in the first quarter this year, we fully repaid the $1 billion term loan that we put in place when we announced the Great Bear deal. So beyond the debt repayment, we're now set up coming out of a very strong 24 with the wind in our sails for 25 going ahead.
Well, congratulations again there, Paul. I want to unpack some of those things, particularly let's start with your comment about holding the line on costs. The higher gold price has enabled a number of your peers to increase their margin. However, most of them saw their costs continue to increase. Are increasing costs something that's inevitable that investors have to get used to, or are companies able to sort of batten down the hatches and really stay on top of those and potentially even bring them down?
It's a great question. I think there's costs going up for what I would call, say, engineering reasons, and there's costs that go up for you missed something, or you didn't see, or you were blindsided. You didn't get enough visibility on your cost profile. I think costs can go up, and I think they can come back down, depending upon what you're doing with your business and where you are in the stage of mine life. And so one of the things that's helped us generally in the last couple of years, and will on a go-forward basis, is we've got an overall theme around grade enhancement. And as we've brought newer stuff out of the development and into the production pipeline, that grade strategy has paid off. So Tasiast, as we completed the 24,000 ton per day mill expansion, putting through those higher grades went straight into the margins and cash flow. And so now Tasiast is a world-class asset and our lowest cost producer. That's grade. Similarly, we restarted La Coipa. Great grades, great cash flow. So, it depends where you are in mine life sequence. Sometimes you're in a heavier stripping campaign. Other years you're in a bit more high grade. For us, though, it's always been about looking for grade supplement. Manh Choh in Alaska, 8 gram material, we truck it, we batch it with the sub 1 gram at Fort Knox. That 8 gram material does wonderful things, grade enhancement. Phase X underground at Round, 3 to 4 gram combined with sub 1 gram in the open pit. These are all great opportunities to offset inflation and expand margin.
Let's follow up on grade a little bit, Paul. A number of your peers, again, let's look at reserve price. The past year or so, a number of peers have increased their reserve price. I think from, let's say, $1,300 per ounce to $1,400 per ounce, depending on the company. Is that a move that reflects the higher price environment we're in, or the higher cost environment we're in, or perhaps a little bit of both?
Look, we as well as many in the industry increased our reserve and our resource price. But it was really more, again, illustrative in terms of a more realistic picture of what you should expect in the context of where the spot price is today. I want to be crystal clear and underline it. We're margin seeking, we're cash flow seeking. So a rise in the commodity price assumption for reserve and resource is just a better understanding of what the cash flow will be. We are not, and again I want to underline it, dropping cutoff grades. Our mills are full. Sometimes people will use a higher commodity price to justify a lower cutoff grade, and we've seen how that movie ended badly in the last cycle back in 2010. In our case, we're moving up those commodity prices, but we were highly focused on margin and cash flow.
Okay. Now, you mentioned that, we've talked about how you've been rapidly paying down debt and now you're sort of growing cash. Are you happy with where your balance sheet is, or where do you want to get your balance sheet to get to?
Yeah, it's a great question. The balance sheet is excellent. It's investment grade. Year end, our trailing net debt to EBITDA as a metric was 0.3. So the balance sheet is in very good condition. We finished the year with over $600 million of cash. But certainly, as we look forward, Q1 for us is seasonally a cash out quarter. It's a cash out quarter because we pay the semi-annual interest payments on our public debt. We pay our taxes in Brazil in the first quarter. We're now, and I'm happy and proud to say, income taxable in Mauritania. And we just paid the balance of that term loan, the $200 million. So we took our $600 million odd, and we'll be using a lot of it through Q1. What we'll want to do then is power back up that cash and then start thinking about return of capital to shareholders.
Okay. Gold company performance is improving due to the higher prices. We're at an investor event, the best investor event in the mining space. Is investor attention returning to the gold companies?
Well, definitely. I think in our case, what I can say is whether it's a combination of our liquidity, our daily liquidity between Toronto and New York is about $300 million a day that we trade. Our market cap in and around US $14 billion. The fact that we pay a dividend, the metrics around the balance sheet, the fact that we've guided more return of capital, we're definitely getting more inbounds from what I would call the non-traditional or the generalist investor.
Well, that's a positive. Gold companies have spent many years showing capital discipline, and now with gold prices soaring, what do investors tell you that they're looking for? Are they starting to get interested in growth again?
I think always, but it's got to be responsible, and defendable return on capital decisions around reinvesting in the business. As I said, again, it goes to our technical culture. We keep a well-maintained business. And the reason we do that is a well-maintained from a capital perspective means lower risk. We're not cutting corners and creating risk or surprise. So our business is very well maintained. Our balance sheet is excellent. We're always looking at growth opportunities. Internally, we have a great pipeline of organic projects, and they all compete for capital internally. But we're also at that stage where we can do both. We can reinvest in our business and our pipeline, and we can still return capital to shareholders.
You've got a sizable internal portfolio of growth projects, Paul, including the asset that everybody continues to talk about, which of course is Great Bear in Ontario in Canada. What are your priorities for capital allocation this year, and how is Great Bear advancing?
Yeah, look, again, if you look back over our profile, we've generally plus or minus, in the postal code of about $1 billion a year. And that's roughly, again, split 50-50, sustaining, keep the business well maintained, low risk, and growth. So 50-50. This year, as we look forward, the growth component of that, and we're up to 1.15 billion. So I say $1 billion with an inflation caveat. So this year, the growth component will be about 615 million, continuing to pull things on the conveyor out of the pipeline into development to continue the production.
Great Bear, looking at your corporate presentation, Great Bear is your biggest near-term new project,
yes.
But you also have other opportunities that exist in operations in the United States, yes. And in Chile. And you mentioned that the projects compete for capital, yeah. Internally. How is that competition going?
It's going well. I mean, the way it works internally is we have a monthly meeting called Capcom. The sites all come in, they request funding for, and these are the smaller, more of the continuous improvement initiatives, those sorts of things. And the important thing here is we say no, go back, do some more work. We don't like the risk. We'd like to see a better return. So that's the competition part. The pipeline itself, we've put a lot of visibility on this recent year-end quarter guidance to give visibility as to what's in that pipeline. And you're right, there's a mix of brownfields at existing sites. That's that grade supplement, like Mancho, the Phase X underground, Curlew as a restart with high-grade underground. And then you've got the new greenfields, most prominent being Great Bear. And behind Great Bear, very shortly after that, is Lobo Marte. Great Bear, it's just been an excellent, I'm really kind of reflective. 3 years ago at this conference, we became the owners. The deal closed. There was no declared resources. People were sort of saying, what are you guys doing? We don't get it. We expected that. 3 years later now, we've drilled out 7 million ounces of high grade. We've paid for the project. We've paid for the acquisition. We've paid off that term loan. We've reduced our share count over that same period of time. And we've put out a fabulous PEA, which is guiding you to expect 500,000 ounces a year at an all-in cost of $800 an ounce. So an AISC margin, if you will, at spot today, the AISC margin at spot would be $1 billion a year of cash flow.
Now, Paul, it was quite a coup in some ways for you to acquire that asset. Obviously, there were a lot of companies whose names were mentioned as possible suitors and acquirers of that. Great Bear was the most exciting exploration project of its generation, and the results you've been putting out, the resource, etc., have shown that, have proven that to be the case. Are you tempted to do it again with perhaps the best asset of the current cohort, which I would argue is perhaps Snowline Gold and its Valley project up in Yukon?
I say in life there's no guarantees, but I will guarantee I'll never speculate on M&A. Look, M&A is difficult. It's very competitive, and things aren't always as advertised. And I get the M&A question all the time, and I say, we have demonstrated discipline. If you go back and you look at the facts, in the last 10 years, we've done 3 deals. They've all been bolt-on. They've all had synergies, and we've borrowed, bought, and repaid. So and you think about all the transactions that have happened in 10 years, we've only done 3. So we're not under any pressure. We've got a great pipeline. We've got a great technical team. And so that's the best place to be of all, where we can maintain our discipline and just wait till we see the right opportunity. If we see that right opportunity, Great Bear is a good example. We're not afraid to pull the trigger and explain to you why we think it's a great deal. But we're not feeling under pressure at all.
Okay, let me throw the M&A question at you from a different point of view, if I may, Paul. One that doesn't focus on Kinross. Last night we saw an M&A transaction that will create a 7.7 billion Canadian market cap company, which is about half of your market cap, more or less. How do you see the competitive landscape in the gold space right now? How do you see it evolving? What do you like about it? What don't you like about it?
Well, look, I've always said I'm a believer in consolidation. I think as an industry, it's healthy. I use the Canadian hockey term. Sometimes we have too many people chasing the puck. And what do I mean by that? It means, people advance things maybe that shouldn't get advanced. And I think with more consolidation, there'd be more discipline on where capital is spent, what gets built, and you'd have less disappointment, especially in the smaller end of the space where you're single asset developers. So I view any kind of industrial logic combination. I haven't studied that deal very closely, but it sounds like it's an MOE. I think that's a great way to preserve value for shareholders. So I commend them on the industrial logic, and I think more of that would be good for the industry.
Okay, now earlier in our conversation you mentioned I think your capital budget for this year is about $1 billion, maybe $1.1 billion. Last year you returned about $150 million to shareholders.
Yes.
You have a 3 cent per share quarterly dividend. Given your pretty full growth and development pipeline internally, both greenfield and brownfield, wouldn't you be better off saving that money and dedicating that towards the expansion capital that is coming around the corner?
We can do both, Paul. I mean, the Great Bear fits right within that $1 billion a year. There's no spike in capital annually to fund our pipeline development. It fits right within the historical, sort of call it plus or minus square bracket $1 billion a year. So we're at a point where we do believe our shares are still undervalued. Certainly on consensus, we would say they're undervalued. Certainly at spot, they're undervalued. As I said, once we get through this Q1 cash out seasonality to our business, we're looking at reactivating our buyback around the second quarter. If you look at the spot price today, as we started in the interview, we did $1.3 billion of free cash flow in 24. At today's spot price, we would do better than that. So if you were to take those same metrics, and it all depends upon the gold price, we think we can have a pretty attractive buyback proposition in the second half of the year, as well as rebuilding our cash to be there for the business as well going forward.
Okay, let's end, Paul, if I may, with a forward-looking question. What are some of the key goals or milestones for the company this year?
There's many, and we put them right into our presentation and our website. I mean, one we've already done, which is repay the term loan. But there's a whole series, whether it's permitting milestones. We didn't quite get into it with Great Bear, but we're well into the advanced exploration program. We've removed the trees. We've got yellow trucks now. We're doing earthworks, civil works. We're getting ready to establish the portal, which will be the start of the decline by year end. So lots of nice catalysts around the AEX. Permitting activities at La Coipa. We just got a permit late in the year in Nevada at Bald called the Juniper permit, which has allowed us to greenlight another satellite development called Redbird. That's another great catalyst. So across the board, reactivating the buyback. We've listed numerous catalysts, milestones that I'd encourage investors to track us and look for in the coming months.
Exciting times.
Yes, it is.
And it's great to see a big smile on your face as well, Paul.
Well, we're really proud of our cash flow. We came up with a new slide. I think we provided it to you folks. It just shows you what, on a relative basis, again, we think that we're still a compelling relative value proposition. When you look at it from the cash flow lens, that free cash flow yield of 8-9%, and if you look at it on the cash flow per ounce of production, what do we get per ounce of production cash flow? It's pretty compelling, and I'd encourage people to take a look at our cash flow metrics. Should be another very good year.
I think you're second best in the industry, just a little bit behind Agnico Eagle, and then quite a gap to everybody else.
That's correct. Yeah, very good. Yes, that's right.
Well, congratulations on a great 2024. Wish you all the best for this year. Paul Rollinson, thank you very much for joining us today.
Thank you for having me, Paul.
And we have a lot more to come from the 2025 BMO Global Metals and Mining and Critical Minerals Conference here in Hollywood, in Florida. So hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining special coverage of BMO's Global Metals, Mining and Critical Minerals is brought to you by First Majestic Silver.